Hello guys, in today's video I'll be diving into order blocks, and so if you have been second guessing while identifying them on the charts, then this video is for you. So without further ado, let me dive in. So what is an order block? An order block, abbreviated as OB, is a refinement of an order flow. It's a single candlestick, I repeat, single candlestick inside the order flow associated with a fair value gap. It should be associated with the fair value gap, and the color of it does not matter. This means it can be bearish or bullish. It doesn't matter as long as it's associated with a fair value gap. But a thing to note is that the fair value gap can be mitigated or unmitigated, but the most crucial thing, there should be an imbalance left. Doesn't matter its size, it can be narrow or wide. I mean the size of the imbalance left, it doesn't matter, it can be narrow or wide, but the order block still counts to be valid. So the fair value gap can be mitigated, but make sure it is not fully mitigated or fully filled. All right, so with that said, then what are the criteria of identifying a correct order block? Criteria number one, previous candle liquidity sweep. So exactly right here on this simple diagrammatic representation, we can clearly see the previous candle high was taken out before price made that ultimate rally down. And also same here on this next scenario, you can clearly see the previous candle high, like price just wicked above that high and gave that rejection to the downside. Now this candle that takes the previous candle high, I mean in the bearish scenario, this candle now a single candle, this is now what we consider as the order block. So yeah, I mean let me change this opacity and also the color so that we can clearly see what we are actually referring to. So this candle is the one that I will be using as the order block, and then now it has only met the first criteria and also the second, this one here, marked on the impulsive move. Let's just assume that this is the impulsive move, and the impulsive move is also the trading range. Of course, you know that. So criteria number 3 and criteria number 1 is done. So the criteria number 2, it should be associated with a fair value gap. So if you have been into SMC for a while now, I want to believe that you know what a fair value gap is. So right here, this candle, it needs to have a fair value gap, and like I said, the fair value gap can be mitigated or unmitigated. So in this case, this here is the candle that took the previous candle high. I mean, we said that the took out can be a body close, it can be by a body closure like in this scenario, or it can be by a wick like in this case. So right here, this candle that took out the previous candle high is the one that we'll be using as the favor. It is the one that we'll be using as the order block. It needs to be a single candle. So this bullish candle is the one that took out the previous high, but then coming down onto this second criteria that should be associated with a fair value gap, you can clearly see it does not meet that criteria number 2. Exactly right here, we can see that this next candle is the one that is associated with a fair value gap. So in this case, then there is some exemption, and since an order block needs to be like a single candle, that's when now you will be diving into this next candle that is associated with a fair value gap. And let's say this next candle is not associated with a fair value gap, you will be shifting on to the third candle that is associated with a fair value gap, and that continues until you get that candle which is associated with a fair value gap. So in this case, I know this is the candle that took out the previous candle high, but I'll be picking this one here which is associated with a fair value gap as the order block. And the reason as to why I'm only picking this is because an order block needs to be a single candlestick inside the order flow. So I said the fair value gap can be mitigated, or it can be mitigated or unmitigated. And the crucial thing is that as long as it's not like fully mitigated, then that order block still counts. So you can clearly see that this fair value gap is mitigated, but there is still some imbalance that is left here. So on top here, there is still some imbalance, and we said the size of that imbalance does not matter. narrow or wide, it's still validating this order block. And by the way, this order block is it is a refinement of an order flow. So if we can check the order flow, you can clearly see that this here is the order flow in that case. So let me change the color of that order flow, and also you can clearly see that this here is the bearish order flow. So this means that we are marking the bearish order block, yeah, because you can clearly see that this here we are bearish order flow. So this means that we are marking bearish order flow, and that's the reason as to why I said these are bearish cases, or it's a bearish scenario. And also the same applies also in downtrend. It's just now the opposite when it comes to the previous candle liquidity sweep. In this case, it was a previous candle high. On a bullish scenario, now it will be now a previous candle low that is being now taken out. And then here, this here is a case that you need to take note at. And by the way, here is something that you guys need to know. I mean, exactly here, let me delete this so that you can have the space. You can clearly see that in this order flow, which price, like, all right, let me just include this break and take this one here. So exactly right here, you can clearly see that there is a liquidity sweep also of the previous candle here. So this previous candle here, like exactly here, price took out the previous candle high, and this candlestick, this bullish candlestick, it's the one that took out the previous candle high. So the first criteria, if you do remember, it's the previous candle. Exactly right here, we say that the first criteria is the previous candle liquidity sweep, and that criteria is met. And the second one, it will be associated with a fair value gap. We can clearly see that there is a fair value gap exactly right here. So the second criteria is met, and it should be marked on the impulsive move. I said this is an impulsive move, and I clearly showcased this one here as a bearish order flow. So this means that in this order flow, there is two order blocks. I mean, in this order flow, there is two order blocks. And so in this case, then this one here is also a correct order block. So right now I can now do this, and yeah, this one here, I should mark this one here to be a order block also. So in that case, so this means in this order flow, which ranges from this high, I mean ranges from this high all the way to this low, that order flow contains two valid order block. That's the first, and this here is the second, because the criteria are met. Previous candle high was taken out. We said the break can be a body closure or a wick, and then that candle that took out the previous candle high needs to be associated with a fair value gap. If it's not, then you shift to the next candle. Like in this scenario here, this candle is the one that took out the previous candle high, but then it was not associated with the fair value gap, and so we had to shift to the next candle, because that next candle was the one that was associated with a fair value gap. We said the fair value gap can be mitigated as long as it's not fully mitigated. All right, so guys, that's now the simple theoretical marking of order blocks. And so let's have a quick recap on the chart. Right, so exactly right here, we can clearly see that the recently formed valid pullback was taken out, and this one here was a confirmed swing point. Then price reversed and broke past our confirmed swing point, creating a valid bearish break of structure. This one here being now the trading range high, and of course this is the low, but not confirmed because the inducement is yet to be taken. And if you do remember, when I was showcasing about when I was talking about order flows or marking of POIs, I said that that trading range, I mean, we start marking the POIs on that trading range once the inducement is taken out. The inducement can be minor or major, it doesn't matter. So I believe by now you know how to differentiate between a minor inducement and a major inducement. All right, so guys, we have just identified our trading range, and this is what we also call the impulsive move. So if I said it, oh, it is the impulsive move or trading range, but our impulsive move is yet complete because we have not confirmed the law. The law is confirmed after the inducement. And exactly right here, we can clearly see that the inducement is this one here, because this here is the recently formed valid pullback. So that's the inducement, and this one here is now where price like made that break of structure. So here is where price made that break of structure, and right here this here is our minor inducement, because I can clearly see if I extend this pullback was created before this bearish break of structure. So right now let me mark price, let me run price and see what price does. Right, so exactly right here, we can clearly see that price has taken out the minor inducement with this big bullish candle. And so once that happens, now we have a complete impulsive move or a complete trading range, with this one here being our low. So right here, we can clearly see that this order flow, this order flow is already mitigated exactly right here. And so in this trading range, typically there is no any valid order flow, because we said the order flow that comes before the inducement is an SMT, and we usually ignore that. So then in this case, this means that we are left with the order blocks only. So we should be considering the order blocks. Like I said, we start on the extreme of the trading range. And so onto the extreme right here, let me now zoom so that we can get a bigger picture. So this one is the extreme, and we can clearly see that the previous candle high right here, this here, yeah, exactly right there. Let me get rid of this so that you guys can see, and also let me get rid of this. Right, so the previous candle high was taken out, and the candle that was associated with the fair value gap right here. So the previous candle high was taken out. Again here coming down, you can clearly see again the previous candle high here was taken out. Exactly right there. Again, down and down and down. Right here, because this here, okay, this candle took out the previous candle, but is not associated with the fair value gap. And we said we shift to the next. And so if the next is also not associated with the fair value gap, you keep going down. So right here, you can clearly see that this previous candle high was taken out. We say it doesn't matter, it can be bare body closure. And this candle, this candlestick, this bullish candlestick is associated with a fair value gap, and this fair value gap that is associated with this is very, very narrow, like very, very small. You can clearly see it there. So if I draw a line here so that I can separate, and you can clearly see that there is a narrow fair value gap there, and that narrow fair value gap is enough to confirm this one here to be an order block. But you can clearly see that price retraced and took out or mitigated that order block. So here comes again another thing. Exactly right here, price took out the, so this here is a liquidity run, not a liquidity sweep, but this one here, all right, this here is also a liquidity run, and now this one is now a liquidity sweep because price wicked above and gave that rejection. So we say that candle that takes out the previous candle high or the previous candle liquidity sweep, that's what we call the the order block, as long as it is associated with a fair value gap. And we can clearly see that it is associated with a fair value gap. If I do mark on the low of this candle, and on this third candle also, we can clearly see that there is a fair value gap that is associated with this low exactly right here. And also we can clearly see that this fair value gap is mitigated, but it is not fully mitigated. So this means that this order block still counts to be valid, because we said even if it is mitigated, as long as there is some imbalance that is left right there, that imbalance is enough to confirm this one here is a correct order block. Again, we can clearly see price retraced back and mitigated this order block. So this means that our order block again is no more valid, because we said mitigated zones are already retested, and price will, price will not like go back again retesting it like may, but we do consider that to be invalid, and so we shift to the one that is unmitigated. And so right here you can clearly see a liquidity run. So price here, yeah, that's a liquidity run past the previous candle high, but this one here is now a liquidity sweep because price just wicked above and then gave the rejection to the downside. And so this candle that took out the previous candle high, so that's what we call the order block. And we can clearly see it's also associated with a fair value gap. All right, let me change the colors here so that we can see what the fair value gap. So you can see here, and in fact in this scenario the fair value gap is not even mitigated, even slightly mitigated. No, it was not mitigated, exactly right here. So this one here is now a valid order block that we are looking forward to take the reversal from because it is not mitigated. And these other ones here, I'm not looking forward for any retest on them because they are already retested. So shifting down again, we can clearly see a liquidity sweep past the previous candle high, exactly right there. And this is the candle that took out the previous candle high. It is not associated with a fair value gap, so I'll be shifting to the next. Shifting to the next, I can clearly see a liquidity sweep past that. And this candle that took out the previous candle high, that's the one that we call the order block. And we can clearly see it's not associated with a fair value gap. So exactly right here we can see it's not associated with a fair value gap. So I shift to the next. If you do remember what I said while identifying while doing it like theoretically, I said if it's not associated with a fair value gap, we go to the next. And this next one you can clearly see that is associated with a fair value gap, exactly right here. Let me change this color so that we can clearly see that is associated with a fair value gap. So now we have our next one that is not mitigated also here. Again, now going down again, we can clearly see here this is also a liquidity sweep past the previous candle high. And this order block, I mean this because this now is the one that is called the order block, but now in this case this is mitigated. I mean, we can clearly see that the fair value gap, even though it was narrow, price reversed back, mitigated the fair value gap, like fully filled the fair value gap and further mitigating our order block. So in this case this is not valid. And we say that the one or the pure white that comes before our minor inducement or before our major inducement, in this case is a minor inducement. So let me just use the word inducement in general. That's not a valid order block. But if I was to mark the order block, then we can clearly see that this is a liquidity run right here. That's a liquidity run. This one here is what we call the liquidity sweep, and this bearish candle is the one that took out the previous candle high. So I'll be considering this, but we can clearly see it's not associated with a fair value gap. I want to believe that each and every one of you knows how to identify a fair value gap if you have been into SMC for a while, because that's literally one of the first things that you get to learn while 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 on your journey towards mastering SMC. So we dive into the next candle. You can clearly see on the next candle also it's not associated with a fair value gap. We said we go on to the next until we get the one that is associated with a fair value gap. And we can clearly see that this bearish candle is associated with a fair value gap. And that's the reason as to why upon price reversing here, it gave this consolidation. This is because this one here was meeting the criteria, but the reason as to why price didn't respected this is because it had not taken out enough liquidity. And this inducement is the what we call the first call liquidity, or the first buy side liquidity that price is heading before it continues with its prevailing trend. So in this case, this is the reason why we don't mark this order block or any order flow that comes before the inducement. So in this case then means in our trading range we only have two valid order blocks, and in that case then we have got this one and this one. So we can clearly see that price disrespected this, and we are only left with one, which is this one, and price has mitigated it. But again, if you do remember, I have said that trades that involve the minor inducement, like they have a less probability of working. And also I said if price or if your trading range has a minor inducement, then the trading range high is what we call the major inducement. So this means price may decide to not like give the ultimate reversal after mitigating this extreme one and just reverse after taking out the major inducement. I mean, this here is not the higher probability reversal, but the higher probability reversal is this liquidity sweep of this external liquidity, or a sweep of this major inducement. So this one here, even though this is the extreme PY, this here is not a like a strong reversal, but the strong reversal or the high probability reversal is this major inducement sweep or the external liquidity sweep, because this here is a trading range high, while at the same time is the external liquidity and is also the major inducement, because our trading range involves the minor inducement. That's the reason as to why I usually love trades that involve the major inducement. Yeah, major inducement available on the trading range, not on the high or the low, yeah, depending on the structure. Because when you see a reversal from the extreme, you just know that that's the high probability reversal, and you will have that full confidence to take the reversal from. So right here in today's video, I was just into the order blocks, and you can clearly see it's not something that is hard. You know the criteria by now, so just practice and practice and practice. And by the way, an extra thing, in an impulsive move, there can only be a maximum of two valid order blocks. Two valid order blocks, or is simply POIs, because it also applies on order flows. It just depends with what the trading range has given. So in this case, there was only just two valid order blocks that met that criteria. So let's say there were like 4 order blocks that met all the 3 criteria. In that case, now you should filter them to only 2, because only 2 in that case they will be working, and the one that will be working is the one that is on the extreme and it is unmitigated. So you can see these are already mitigated, so this here is on the extreme and it is unmitigated. That's the first one, and it is the one that is easy to identify. The second one is the one that comes immediately after the inducement is taken out. So you just check the one that is coming after the inducement is taken out. Yeah, after the inducement is taken out, the one that comes immediately, that's what we call the decisional. Any ones that are appearing here or appearing like yeah, of course they'll be here, like in between here, those they are all SMTs and they should not be considered to be valid. There can only be a maximum of 2 valid order blocks. So guys, I have done my best to make it clear, and if you have learned something or if you have enjoyed the video, drop a like, and yeah, see you in the next video as usual.